I'm Carol Alexander. I'm Professor of Finance at the University of Sussex. I'm also a visiting professor at Peking University PHBS Business School. And I'm going to talk to you today about the impact of COVID-19 on financial markets, banks, and the global economy. So if you bear with me a moment, I just need to share my screen. Okay, so you should still be able to see me in the corner, and I've divided this talk into 3 parts. I don't know how long it's going to take, maybe 10 minutes, 15 minutes each part. So let me just give the outline to begin with of what I'm going to talk about. So central banks, the Federal Reserve, Bank of England, not so much the People's Bank of China, but in the Western world, most central banks have responded to the pandemic with some unprecedented interventions in financial markets, which effectively amount to printing cash to buy company stocks and bonds, household debt, and even their own government securities. And under Donald Trump, it appears that the strategic aim of the US is to artificially inflate the prices of US stocks and bonds and all US assets, decrease the values of safe haven assets such as gold and Bitcoin and other cryptocurrencies, as well as the US dollar itself, which is very useful to boost exports if the US dollar devalues. And in fact, we can trace this type of tactic back to the Great Depression of the 1930s in Franklin Roosevelt's first term. In fact, in his first 100 days, he implemented some emergency economic stimuli, which had the same effect. Currency and gold price manipulation in particular were used right at the beginning. Also, since the banking crisis of 2008, this monetary policy type tool has been deployed continuously in the form of something called quantitative easing, which I'm sure many of you have already heard of anyway. And the question is whether this is really masking the true weakness of the US economy. And has it just been propped up by continual rounds of quantitative easing since 2008 or even before? So I'm going to talk about the Great Depression in this talk, and then the next one, part 2, will be about the development of financial markets leading up to the banking crisis. And then in the third part, I'll talk about how we might be able to learn from these previous crises, the way that governments have handled them. Will banks and financial markets respond similarly to the packages employed today, or have the Federal Reserve and other central banks actually got to their last resort with nothing left? This is the question. All right, so to begin with this part, we'll be looking at how the US economy in particular fared after the 1929 stock market crash, and the role of banks, commercial banks in particular, and the Federal Reserve. This is when the FOMC, the Federal Open Markets Committee, which we all look at today for its announcements. Wall Street responds quite quickly to anything the FOMC does, but the establishment of that goes back to Franklin Roosevelt. And we'll look at how financial markets have been used to implement economic policy and how the US economy recovered from the Great Depression. So here's a couple of graphs, not mine. On the left, you can see the US gross domestic product in billions of dollars, constant terms. So there was a great recession, but not for long, only a couple of years. But the depression with the high unemployment rate lasted for 10 years. And following this time, GDP recovered and the US unemployment went almost to zero. So it's these years that the emergency packages after the stock market crash of 2029 and the very high unemployment rate, these emergency packages that Theodore Roosevelt brought into play were attempting to increase exports via US dollar devaluation because domestic demand had all but gone with such high unemployment. Demand for agricultural products in particular was very low, demand for cars, US manufacturing and agriculture more or less came to a standstill. And to boost new infrastructure and manufacturing, there was also an increase in the money supply. But in those days, trade was done in silver or gold. They had the silver dollar for domestic trade and gold for international trade. So how did they increase the money supply effectively back in the 1930s? Well, I'm just going to focus on the 1934 Gold and Silver Acts, which effectively changed gold and silver from currencies into commodities, albeit the gold standard for a long time was very closely linked to the value of the dollar. So on the left here, you can see a presidential order in 1933, very soon after Theodore Roosevelt came to office, the confiscation of all the gold owned by US citizens on fear of a very large fine. In fact, the Federal Reserve acquired 4,300 tons of gold bullion during this period, and it paid $20.67 per ounce for this gold. That was the gold standard at that time. But very soon after, it revalued or devalued the dollar effectively, so that versus gold, the unit of international trade, after all, the dollar was devalued by 70%. So the new gold standard was 1 ounce of gold equals $35, and it remained this way until the gold standard was dropped later on. And on the right here, you can see a picture of the silver mines, past and present. The blue and the red dots are the highest quality silver. And not only are they almost exclusively, although for a few in Australia and South Africa, but they're almost exclusively on the west coast of the Americas. And this area has the world's monopoly in silver production. So there was a very powerful farming lobby when Theodore Roosevelt first took office, but it wasn't just the farming lobby, it was also the silver lobby. The value or the price paid for silver was too low, and so the Federal Reserve purchased silver direct from the mines at a 50% premium, called a seigniorage tax. And in return gave silver certificates. And this resulted in an increased price for silver at the same time as effectively increasing the money supply. The silver certificates were a paper form of money instead of the silver dollar. It also had the side effect that the Chinese economy, which was the last economy to actually adhere to the silver standard, had eventually to drop that because of the pressure on the silver price. And it's then introduced a fiat yuan that was initially pegged to the Japanese yen at that time. So the role of commercial banks is quite important at this time, because although the 19th century banking laws prohibited commercial banks from operating in capital markets, they got around this by finding loopholes in the laws and setting up subsidiaries which are now called investment trusts. In this way, they boosted demand in stock markets and contributed to the stock market bubble of the 1920s. So these two rather stern-looking men, Glass and Stegall, were US senators that introduced an act in 1932, which made a clear distinction between the activities of commercial and investment banks, and in particular made it impossible for commercial banks to gamble with the savings of ordinary consumers on stock and other capital markets. So that was the Glass-Steagall Act of 1932. In fact, that act was incorporated by Roosevelt into the 1933 Emergency Banking Act, which was an extension of the 1913 Federal Reserve Act. Here you can see a photograph with another photo of Senator Glass, which explains the setup of the new Federal Reserve. There's a board of 7 members to supervise the entire banking system in the country, and regional banks, 12 of them actually. And this Federal Open Markets Committee that I mentioned at the beginning consists of 5 of the 12 Federal Reserve Bank presidents and the Federal Reserve Board members. And the purpose of this committee is to control interest rates and the money supply by issuing treasury securities, that's at the short end, short maturity treasury bills and notes, and then at the longer end treasury bonds, and not only issuing them but also buying and selling them in what we call open market operations with special banks, usually the JP Morgan, Goldman Sachs, Citibank, the bigger banks that are the primary dealers, the only banks that are allowed to deal directly with the Federal Reserve. And it's through these open market operations that it creates money. It used to be in paper, but now it's done just digitally. There was also a role for social media for Franklin Roosevelt, just like for Donald Trump. He started fireside chats. You can see a photograph of him here, a very flattering photograph with the microphones, the radio microphones in front. And I find it very interesting to listen to those recordings. In particular, the very first one, when he first took office, he's explaining to the general public that banks are not just there to take savings and make loans. They're also investing in capital markets. So this was after the Glass-Steagall Act was incorporated into the Banking Act. So these fireside chats, very interesting. As I said, you can hear the recordings, and this right-hand side, with not such a flattering photograph of Theodore Roosevelt, contains the transcript of one of those chats where he explains the response to the second downturn in the economy in 1937. So there were more economic stimuli around that time because unemployment started going up again. At the same time, introduced accounting reforms because Theodore Roosevelt felt that mark-to-market accounting was another contributory factor in the stock market crash of 1929. And basically, when companies are allowed to mark their assets not in terms of the book value or what we call cash accounting, the cost of their assets, but they can look at the market and say, oh, that's what the market values my assets at the moment, so that's the value I'm going to put down in the accounts. And if companies like General Motors see their share price going up and up, then it's easy for them to inflate the actual value of that company so that it looks like their assets are worth a lot more than they really are according to the book value. And that's one of the reasons why so many companies went bankrupt following the 1929 stock market crash. Now, the recovery from the Great Depression did not actually happen until World War II broke out. At that point, the ailing car manufacturing industry in the US turned itself to manufacture military equipment. So here you can see a couple of propaganda posters or a book about how the US must become the great arsenal to save democracy. And indeed, the manufacturing industry in the US took off. Millions of guns and bombs, 300,000 planes, 50,000 tanks, 600,000 jeeps, 2.5 million trucks were manufactured. So unemployment, as you saw in the original graph of this talk, decreased to 0. And industrial production increased to 15% per annum. And the gross national product also increased, almost doubled during the war years. Towards the end of the war, in 1944, sorry, there's a typo here, it's not 1994, it's 1944, of course. Bretton Woods was a place in the US where the 44 Allied countries met, led by John Maynard Keynes from the UK and Harry Dexter White, a US economist. And there was a famous argument between these two economics. The purpose was to stabilize exchange rates because before the war, there'd been competitive devaluations in currencies, not just the dollar, but the UK and other countries also tried to devalue in order to increase exports. So rather than return to that environment, eventually Harry Dexter White won the argument, and instead of having the reserve currency, the currency where, in fact, it turns out more than 60% of world trade is now done, being a basket currency, like the IMF's special drawing rights, the XDR is a basket of currencies. It's a trade-weighted basket, although at the moment there should be a little bit more of the Japanese yen and definitely the Chinese yuan. So at the moment, the constitution is 41% US dollar, 30% euro, almost 11% yuan, 8% yen, and 8% GBP, the sterling. Instead of having that type of basket, the Bretton Woods agreement was to peg all exchange rates to the US dollar within 1%. And the reason for that was because the US had so much gold that they agreed to adhere to the gold standard and would not print more dollars than they had gold, on the parity of 1 ounce of gold was equal to $35. So this prevented them from making the dollar into a fiat currency where they can just print as much as they liked. And these special drawing rights of the International Monetary Fund were there for countries who needed, with this fixed exchange rate regime, they needed, if the currency became too low, they needed to buy their own currency and required reserves for that. Or if the currency became too high, they needed to sell their own currency and put reserves for that back into the International Monetary Fund. So these special drawing rights were used to help maintain parity with the US dollar. Now, established back in 1934, I didn't mention this when I was looking at the Gold Act and the Silver Act, but the proceeds from the 1934 Gold Act were almost $3 billion when they bought gold for about $20 and then automatically revalued it at $35. And a large quantity of that was used actually as a response from the UK, which had its own exchange equalization account. The US established an Exchange Stabilisation Fund. And it was originally used to intervene in the foreign exchange markets to stabilise the value of the US dollar versus gold, as it had the gold standard from 1934. But the Bretton Woods Agreement gave a permanent authority to the Exchange Stabilisation Funds, for instance, to finance short-term loans to Latin America and other countries during their financial crises while they were negotiating longer-term loans from the IMF. But also, the Exchange Stabilisation Fund was able to deal not just in the US dollar and gold, but other currencies, and keep profits within the fund. So this fund is within the Federal Reserve and is subject to much speculation. I mean, there's all sorts of videos if you have a look on YouTube about how the Exchange Stabilisation Fund links with the CIA and drugs and money laundering and all sorts. But the point is that there is this vast amount of cash. In fact, by October 2009, after the banking crisis of 2008, the ESF held assets worth 105 billion, including 58.1 billion in special drawing rights from the IMF. So I'm going to leave this first part with the Exchange Stabilisation Fund because it has begun to play an increasingly important role in what is happening today in response to COVID-19. So now I can stop the recording.